All right. Today is Tuesday, March 29th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and I know it's a little too late, you're already too tired, but pretty please give yourself a little Will Smith smack right in the face and wake up, because we got important stuff to talk about here, and let's not waste any more time. Here it is, in focus tonight. The dreaded inversion of the yield curve, well, it is here. Is it a big deal? Is it not a big deal? Should we grab the diapers already? We'll talk about everything, but the melt-up in the stock market continues, which is, by the way, a bear market rally. I'm going to share some information with you at the end of the segment, but this time around it was due to the peace optimism. The Russia-Ukraine peace talks. There is progress. We know all of these scams with Wall Street. Every time we have a bad event, like the trade war, for example, and this time around, the Russia-Ukraine war, it started out as negative, and then Wall Street looks for any glimpse of optimism and uses that as an excuse to initiate a rally. Oh, the trade talks are going okay. Oh, somebody called somebody. We're going to move the market higher. And when it comes to the Russia-Ukraine war, it is no different. Somebody met somebody. Somebody wants to talk about something. Here we go. Let's move the equities market higher. I don't buy any of that shit. I believe that they're going to move the stock market higher either way. And then the excuse comes after the fact, because funds are pumping the stock market with billions of dollars in pretty much autopilot kind of flows. Why? Because I told you, it is the end of the quarter. If the S&P 500, for example, closed the quarter down 14% or 15% as it was a few weeks ago, these fund managers would have gotten slaughtered. But then you pump the stock market with billions of dollars of investors' money, regardless whether this is the sound decision to make or not, just to lock in the illusion that, yeah, we closed the quarter down just 3 or 2%. No big deal. And when we talk about the Russia-Ukraine peace agreement, how does this jive with the progress in peace talks? Apparently, Russian oligarch Abramovich delivered a note to Putin from Zelensky, and Putin looked at it and said, "Tell him I will thrash him." Does that sound like we have peace progress between the two countries? Of course not. You really think Putin's going to take a loss? If anything, he's playing a new game here to buy a little more time because his initial plans did not go as expected. And you watch, after the quarter is over and closed, all of a sudden, the Russia-Ukraine tensions are flaring up again. We're going to sell off the stock market. But perhaps the most important event today was the inversion of the yield curve. Yesterday, we got the inversion between the 5 and 3-year Treasury yields. Today, we got the most important one briefly, for a moment today, between the 2 and 10-year yields. What is the problem, by the way, with the inversion of the yield curve? And what does that mean? To begin with, think about it like this. When you buy a 30 years bond, well, you should be expecting to get paid more than holding the 10-year, for example. And when you buy the 10-year, you expect higher yield than when you buy the 5 or the 2-year, because you're holding that bond for a longer amount of time, and you expect the reward would be getting higher yield. But what happens when the 2-year yield, for example, pays more than the 10? Well, that is called an inversion of the yield curve, because the 2 is paying more than the 10. Doesn't make sense at all. And it is a sign of a recession, an upcoming recession, because it tells you that the optimism in the short run in the economy, 2 years, surpasses the optimism in the economy 10 years from now, and hence you're getting paid more holding the 2-year versus the 10. In a healthy yield curve and a healthy economy, you have what is called the steep yield curve, where the 30-year bond pays more than the 20, and the 20 pays more than the 10 pays more than the 5 pays more than the 2, etc., etc. But in a flattening yield curve, and worse, a inverted yield curve, the opposite starts to happen. The shorter end starts to pay more than the longer end, and it is a reliable sign for an upcoming recession. Pretty much every single time we saw an inversion in the yield curve between the 2 and 10, that preceded a recession by a year or two. As you can see from the chart, in the late 70s, early 80s, the inversion was a predictor, a spot-on one for the recession in the early 80s. Likewise, in the early 90s, similar story. In the early 2000s, when the yield curve inverted, and we saw the bear market for years along with a recession. And then the most famous one at around 2006-2007 when the yield curve inverted. And we all know how that story ended with the great financial crisis and the recession that followed thereafter. And then we had another inversion at around 2019. We got the recession in 2020 from the thing. And what's really important to watch for here is the following. The more aggressive the inversion is, meaning piercing below the zero line, as you can see from this chart, the more aggressive the inversion is, the more aggressive the recession will be. For example, back in the 80s, the inversion was steep and was aggressive, and hence the recession was also steep and aggressive. Likewise, the longer the inversion stands, the longer the recession. For example, in the 06-07 case, the inversion lasted for a long time, over a year, and then it inverted again, and that predicted the length of the recession that we got in the aftermath of the financial crisis. Likewise, in 2019, it was pretty much a peak below the zero line. It was a momentary inversion, and then the yield curve snapped back right away. And hence, the recession that we got in 2020 did not last for too long. Now, you might ask, how would the bond market knows all of these things? What is it, Nostradamus over here? I don't know, but it is a spot-on predictor, not just for the length of the recession, but for the severity and when it's going to happen. And you cannot deny these facts. So what we got today in the inversion of the yield curve, be it momentary, is quite significant because it has always been a reliable indicator for an upcoming recession. And for now, we got a momentary peak below the inversion threshold. We'll see what happens tomorrow. We'll see what happens in the days to come. Perhaps weeks to come. How bad will the inversion be? How steep will it be? And how long will it last? Because all of this information, the behavior of the inversion itself, is telling about the characteristics of the upcoming recession. How long will it last? How steep and aggressive would it be? Etc., etc. But bear in mind, the pumpers, the morons with the blindfolds on, whose sole purpose in life is to pump equities higher, are going to start to come out of the woodwork saying, don't worry about the inversion of the yield curve. It is not a big deal at all. And they're already coming out, by the way. The Financial Times, for example, came out today and said an inverted yield curve need not to cause panic. Recent moves in bond markets do not necessarily point to a recession. Oh, really? Let's go back to 2019 and see what the geniuses said. Goldman Sachs says, don't give in to inverted yield curve panic. Come on, man. Barron's, 2019, said, don't panic. Worries about inverted yield curve may be misleading. Oh, really? Also Barron's. And mind you, this is from 2019. It reads, an inverted yield curve is usually scary. Not this time. Oh, really? Even Mohamed Al-Arian, back in 2019, said, don't panic about the yield curve inversion. What the hell is wrong with these people? Back in 2007, the Fed chairman himself, Bernanke, came out and said the inverted yield curve is not an economic threat. We all know how that story ended, right? Matter of fact, back in 2007, the Wharton School of Business, we're talking about the good professor, Jeremy Siegel, who's been wrong pretty much about everything, came out and said, don't sweat the inverted yield curve. No one really knows what that means. And I think we all knew and know how that movie ended. So watch out here, because let's say if we have an inversion of the yield curve by tomorrow, for example, a big one, not just a little peak, and we see the equities market reacting negatively, they're going to come out of the woodworks telling you, don't panic, it's a false signal, yada, yada, yada. And now you know. The yield curve has always been a spot-on predictor of an upcoming recession, which makes it inevitable now. We got the signal. This economy is heading into a recession, no doubt about it at all. Are you prepared for that or not? Even former New York Fed President Bill Dudley came out and said the Fed has made a U.S. recession inevitable. Jerome Powell is far too optimistic about the chances of a soft landing, which is a fantasy, by the way. Soft landing like Boeing, right? One of those Max flying coffins where the nose hits the ground, that's soft landing for you. And specifically when the captain of the Titanic, Jerome Powell, is the one landing the plane. There is no soft landing. He, Jerome Powell, might end up living because he's a lizard, but the rest of us will die. The economy will die in the so-called soft landing. Now, you gotta understand this. An inverted yield curve is not a death sentence right away for the economy or the equities market. Matter of fact, after the inversion happens, we see equities performing for about a year or two before the recession takes place and the stock market crashes. I'm not saying this is what will happen here, but I'm saying now that we have a solid, reliable signal the economy is heading into a recession, we have to prepare accordingly. It could happen next year. It could happen 6 months from now. It could happen 2 months from now. Nobody knows. But we got the warning signal that it will happen, but nobody knows when exactly. But we can read the tea leaves. What will cause the recession to happen? The answer is the Fed aggressively tightening the monetary policy. and raising interest rates higher. Now, you might say, why would Jerome Powell do that? The economy is fine right now. It is actually not, because we have this thing we call inflation. I don't know if you heard about it or not. And the longer you let inflation loose, the more likely the economy is going to dip into a stagflation phenomenon, which is destructive. And the end result would be, to tackle stagflation, the Fed will have to do the same thing by increasing interest rates abruptly to hit that inflation. But at that time, you already have an economy that is already stagnating. When you hit it with interest rate hikes to tackle the inflation part of the stagflation, you risk dipping the economy into a depression or prolonged recession. But if you start increasing interest rates before the stagflation takes place, when growth is somewhat still intact in the economy, you have a little buffer to do so without risking pushing the economy into a prolonged recession, or worse, a depression. But time is running out for the Fed here, because that growth that accompanied inflation from the beginning, we're seeing a divorce now between the two, where inflation continues to move higher and growth continues to stall, and matter of fact, trend down. Listen to PIMCO. PIMCO says, the risks have increased for an anti-Goldilocks economy where growth is too cold and inflation is far too hot, aka stagflation. And the dilemma for now is, what do you do as the Fed, knowing that you're already too late? Do you allow inflation to continue to go rampant, or do you start tightening right now aggressively and risk pushing the economy into a recession? Well, I already told you my views. Waiting for stagflation to intensify is critically dangerous, because as the Fed, you want to be tightening and increasing interest rates while the economy has the cushion and the ability to absorb these interest rate hikes. The longer you wait, the lesser the ability of the economy to absorb interest rate hikes. So doing the increase in interest rates now is a lot better than waiting, specifically waiting after stagflation becomes rampant. But here we have Mohamed Al-Arian, for example, who says it is a lose-lose situation, because you either have a hot inflation that will evolve into stagflation, or you're going to have a recession right away if the Fed starts tightening aggressively now. But Al-Arian says higher prices will be preferable to the recession. So after all of the complaining and saying that the Fed is way behind the curve, yada yada yada, now Al-Arian says they shouldn't increase interest rates at all. Just let inflation go rampant, because it is better than a recession. I happen to disagree. The longer you wait, the more dangerous it will become. Inflation is not going to go away on its own. It requires Fed intervention sooner or later. And we're already downgrading the picture of the global economy. The Russia-Ukraine war alone is going to take about a point of US GDP. What do you think will happen when the Fed starts to increase interest rates? Tightening the monetary policy, in effect, is crushing demand in the economy, which will reduce the GDP even more. And how could they be so callous about inflation and allow it to go rampant? I think a recession is the best case scenario, specifically if it is a shortened recession. It lasts for a few months, maybe a year, and then the economy starts to recover again. Rather than saying, hey, let's not do a recession and let inflation go rampant, and let's see hyperinflation in this country or stagflation in this country, and then we say, okay, we were wrong again, and let's slam on the brakes now way more aggressively by increasing interest rates even more rapidly than the Fed is planning to do so. And that will indeed guarantee a massive recession. Take your pill right now and deal with it, because inflation is getting out of control as it is. It now costs $2,400 a week to fuel trucks. This has ripple impacts across the economy. Everything that is transported by trucks will increase in prices, be it oil, be it gas, be it food, be it furniture. And on top of that, today we got data about the housing market, and that inflation is getting out of control. With certain cities like Phoenix, Arizona, for example, where the inflation is over 32.5% year over year in housing. Folks cannot buy homes anymore. The American dream is dead. Rents are crazy. You have people so scared. What will happen to me when my lease expires? How much of an increase would my landlord demand? Will I be able to afford it? What if I lose my job? What happens then? It's a nightmare for the majority of the households in this country, that if anything wrong happens, you could end up in the street right away. There is no supply of homes. Rents are surging out of whack. It is becoming really scary, the possibility of average Americans becoming homeless now. It's not just crazy drunk people who use drugs. It's anybody. The moment you lose your job, the moment you get kicked out of your apartment or your home because you cannot afford the increase in rent, or you got evicted, the risk of being homeless is widespread now. It could impact anybody. What are you going to do? You're going to buy a used car to sleep in, well, those cost an arm and a leg these days. So this is becoming a big problem. Inflation is becoming a massive problem. And with all of this inflation, what is going on with the growth in the economy? Because if that is intact, then it is not too late for the Fed to start tightening. But the moment you see growth in the economy flattening while inflation continues to move higher, it is becoming too late because this is stagflation. You tighten. Amidst the stagflation, you're going to damage the economy dramatically. And here's what's going on with the pace of growth of this economy. U.S. business investment, for example, fell in February for the first time in a year. So here you have inflation moving higher, the pace of economic activities moving down. And when we talk about housing, by the way, the prices are still high, but mortgage rates are moving higher. So the pace of economic activities in the housing market will slow down dramatically because mortgage rates are moving higher. Yet prices continue to linger higher. So we will have a stagflation phenomenon in the housing market too. And it is no surprise that consumer sentiment is plummeting among all incomes, but specifically those earning under $50,000 a year, because people now have to prioritize their spending. If they're spending more in rent, gas, and the grocery store, they're going to have to cut spending on other things, like dining out, for example, traveling, and that in itself slows down the pace of economic activities in the economy. Inflation is becoming a massive problem now. According to a Gallup poll, for example, when people are asked, what is the nation's biggest problem right now? Slowly but surely, high cost of living / inflation is becoming the number one problem for this nation, even bigger than the government and politicians, which is quite extraordinary, by the way, because you cannot top those fools to become the nation's biggest problem. It's not that easy. Inflation is on the top of minds of most Americans to a degree not seen since the 1980s. So again, yes, the Fed has no other choice but to start tightening aggressively right now, as soon as possible, which will get us into a recession. This was confirmed today by the inversion of the yield curve. And you might say, oh, what about the jobs market? What about the consumer spending? The consumer is so strong. The consumer is flush with cash. All the propaganda you've been absorbing from CNBC and the likes. Well, we got data today from the UK. People in the UK borrowed a net £1.5 billion in credit card debt in February alone. This is the highest monthly amount since records began in 1993. This is what's behind the so-called strong consumer, swiping those credit cards up and down, up and down, up and down, while interest rates are moving higher. This will be disastrous for this economy. What will happen when people start losing their jobs? And it will happen, by the way, while they have higher interest rates, higher debts on their credit cards, when they have mortgages they cannot afford because the zombies, the morons, locked in these mortgages at a lower rate but an insane housing price. And oh, by the way, the equity value of that house is plummeting, will plummet when we get there. What will happen to all of these people? Is the government about to bail them out? We have to start asking these questions now. What will happen when the economy starts to slow down, people start to lose their jobs, and they have this insane debt in credit cards, mortgages, student loans, buy now, pay later, because the most important question to this economy, and when we talk about recession and how will this thing collapse, because you might say, wait a minute here, we have one of the lowest unemployment numbers in history. The job market continues to be strong. Just look at the job openings that we got today. We have millions and millions of job openings. The economy is so resilient. It's not going to dip into a recession, Maverick. Think about it this way. The same was said, by the way, back in 07, 08. We all know how that story ended. When the Fed starts to tackle inflation by increasing interest rates, what are they trying to do effectively? Inflation has a problem of two sides. Supply and demand. The supply problem, for example, we have a lack of fertilizers due to the Russia-Ukraine war. Well, that's not going to be solved by the Fed. They got no control over that, but they got control over the demand side. And I've been telling you all along, this inflation, the core of this inflation has been a demand problem. When the Fed started flooding the system with cocaine. Well, now if you're taking the cocaine away and you're tightening the monetary policy, you're effectively eroding the demand in the economy. You're trying to slow down the demand. You say, okay, the supply side is not going to be solved anytime soon, so let's hit the demand. We hit the demand by tightening the financial conditions, by increasing interest rates. What do you think happens when you destroy the demand in the economy? You think people are going to go out and spend more? You think people are going to buy more from businesses? Of course not, because they're getting hit now by inflation from one side and by the Fed, who's trying to fight this inflation, and we become collateral damage in the fight between the Fed and inflation. When we don't spend more and the demand gets crushed in the economy, guess what happens to corporate earnings? Do they go up? Or do they go down? I think the answer is clear. Corporate earnings go down. Revenues go down. Profits go down. Matter of fact, Citigroup's Global Earnings Revision Index has turned negative for the first time since September of 2020. When corporate earnings come out weak because the demand is being destroyed in the economy, what happens to these stocks of these companies? They go down. When they go down, what I know, that we have an economy that tracks the stock market, not the other way around, like it used to be, like it's supposed to be. So when stocks start to go down, and now companies looking around and saying, wait a minute here, the Fed is eroding demand in the economy. So do we need to be expansionary in our hiring? Do we really need all of these workers when demand is slowing down in the economy? What do they do with these workers? The answer is they fire them, just like we saw back in 2008, 2009. When people start to lose their jobs, the dominoes start to fall apart really fast. Think about it like this. The Fed is playing a game of Jenga, attempting with a soft landing. They're pulling those blocks carefully, slowly, right? But once you pull that block of people losing their jobs, the whole house will come down collapsing. And all of these people who lost their jobs and they don't have an income anymore and they have debt all over the place, not to mention, by the way, margin debt. After all of the gambling that's going on in the stock market right now, it's going to be a disaster. And by the way, when we talk about the stock market, everybody's excited right now. You don't understand, Maverick. The stock market is going back to all-time highs. The bear market is over. You're just practicing FUD. You're perma bear, bro. Be careful what you wish for. If the Fed was accommodative, if the macro environment was accommodative, I would have said you're right, but you're not, and you're gonna get caught with your pants down. Bank of America is warning now that this so-called market rally that has been going on for over 2 weeks now is a bear market trap. What are they talking about? That is the conclusion of analysts at Bank of America, who say warning signs are flashing for a market that has climbed despite clearly weaker fundamentals, including a Federal Reserve bent on raising rates sharply this year to battle persistent inflation. The strategists caution that the sell-off that took the S&P 500 12% from its January record is not over, and sharp rallies are typical of volatility in bear markets, with some of the biggest on record occurring in the throes of the dot-com meltdown and the global financial crisis. A closely watched Treasury market metric flashed a recession warning Tuesday, adding to worries a restrictive Fed will damage the economy. The worsening macro backdrop and market-unfriendly Fed makes sustained U.S. equity gains unlikely. The Fed is not likely to come out to the market's rescue at any point, and in fact, the central bank is welcoming of tighter financial conditions to aid its battle against inflation. In practice, this means lower risk assets. For now, investors are not heeding any warnings. The S&P 500 jumped 1.2% Tuesday for its 9th gain in 11 sessions, even as the yield on the 2-year treasuries popped above the 10-year rate for the first time since 2019. But 10-day stretches of big gains have been common in bear markets. There were 4 that exceeded the 10-day rally of 10% through Monday. In 11 bear markets since 1927, the Bank of America strategist wrote, it is not hard to find reasons for caution. The war in Ukraine still has commodity markets in turmoil, with fertilizer, the latest product, to skyrocket in price. Oil prices are still elevated, adding to the inflationary pressure the Fed has promised to tamp down, even if it damages demand. The strategists recommend investors sell out of the money calls to hedge against both downturns as well as any potential short-term run-up, which they say will be limited, quote unquote. So they're saying sell upside calls. This is exactly what I'm doing right now. Bulls argue that despite the Fed's push to slow growth, companies will still be able to deliver profit gains that justify valuations. Corporate America in particular is most insulated from the impact of sanctions on Russia, at the same time that bonds around the world have been in free fall. Bank of America strategists said it would take softer inflation for stocks to be able to add to the latest gains, something the bank's economists do not expect. They also warned that any easing of tensions in Eastern Europe would remove a threat to growth, but also give the Fed cover to hike faster. The rates markets, for one, are exhibiting a lot more signs of stress. An increase in rates volatility over the past 10 days, as measured by the MOVE index, relative to falling equity markets volatility, as measured by the VIX, has been the largest since 2009. 9 and is one of the biggest ever, Bank of America says. Following the 2009 episode, listen to this, the S&P 500 fell 7% over the following 6 weeks. And again, look at this, the biggest rallies happen under bear market rallies. Everybody thinks we're in the clear, we're out of the woods, the stock market is up 10, 12, 15%, and then what do you know, they pull the rug and they flush the market again. We're not out of the woods yet, specifically given the degree of arrogance, complacency, and mania that is still going on in this market. They're still stampeding on meme stocks. They're still getting excited by stock splits. The bulls might be emboldened right now after a significant rally in a few weeks, but you watch. The tide will turn, and it's going to be extremely painful. And with that, folks, we're going to move on here and cover the market information for you. We start with the performance of indices today, and here we go. The Dow Industrial Average closed in the green by 338.30 points, or a gain of 0.97%. The Nasdaq also in the green, leading the pack by 264.73 points, or a gain of 1.84%. The S&P 500 also in the green by 56.8 points, or a gain of 1.23%. And here are the sectors' performances today. Every sector of the market closed in the green, so we're not going to shame anybody, but at number 1, capturing the gold medal, REITs, interesting. Number 2 for the silver, cyclicals. Number 3 for the bronze, technology. The laggards, once again, energy and materials, the winners for the year. What about the advanced decline ratios? NYSE 79% advancing versus 18% declining. The Nasdaq 74% advancing versus 22% declining. Yesterday was bad breath for the Nasdaq, and we thought it might be a sign for an upcoming pullback in the Nasdaq, and what do you know? The Nasdaq blasted higher today. Now that the breadth is actually good, could it be the other way around? That the Nasdaq will pull back on good breadth, not bad one? We'll see. Let's move on to commodities. And right away, energy commodities were down. Matter of fact, the majority of commodities were down because we got the rumors of a peace deal between Russia and Ukraine, which I take, for now at least, with a grain of salt. But regardless, it is opening opportunities for profit-taking in these commodities and perhaps some dip buying. Today, crude was down, beat off the lows. The WTI, for example, closed the day with losses of almost 0.75%. Likewise, Brent closed the day down with almost 1%. The negative catalyst today was the peace talks between Russia and Ukraine, but what rescued crude oil prices off the lows was the news that the Saudis might increase the prices they charge Asian consumers for oil. We're talking about $5 more. Likewise, gasoline was down, heating oil was down big, almost 10%, and natural gas was down almost 4% today. But keep in mind that the deal between the US and the EU is still here. We're about to supply the EU with 15 billion cubic meters of natural gas, so the demand for natural gas will improve dramatically. On top of that, March 31st is the deadline that Vladimir Putin gave for all of these countries, European countries, to pay Russia with rubles for natural gas. The Germans told him to get lost. The French today told him to get lost. What would Putin's reaction be now? Will he cut gas supplies to European countries altogether and say, hey, I wasn't joking here. When I say pay me with rubles, I meant it. Pay me with rubles, otherwise you're not getting gas. What will happen then? When it comes to softs, lumber was the winner, surging over 5.5% today alone. Likewise, cocoa closed in the green with gains of a little over 1%. Coffee was pretty much in the flat line, but we have losses led by sugar. Sugar losing over 2.25% today. Cotton was also among the losers, along with OJ, all losing a little over 1%. What about metals? Down across the board. Gold down, silver down, platinum down, palladium down big, over 4%, while copper was the only green light in metals, gaining almost half a percentage point. Meats. Upside day for both live and feeder cattle futures. Big gains for feeder cattle, specifically over 2.5% today alone. On the other hand, lean hogs down by a little over 1%. What about grains? Red across the board. We continue to watch wheat. Wheat was down over 4%. So was oats. And then we had lesser declines for corn, soybean meal, soybean oil, soybeans, rough rice, canola, all in the red. And this action, by the way, impacted agricultural stocks negatively, as we will see in the heat map analysis. Moving on to the big casino, the options market. What's going on here? The hottest table by far is Apple at around 1.5 million contracts traded today. About 61% of those were calls. Number 2, AMC, with around 800,000 contracts, about 66.5% of those were calls. Notice the volume is receding for AMC, and as we get closer to the end of the week, all of these guys who are holding calls, with the expiration date of Friday, they're going to start to close these contracts, and the stock is going to go down. Tesla, number 3, with around 600,000 contracts, about 60% of those were calls. Let's talk about the unusual activities that took place in the options market today. We start with the ticker HOOD, the Hood, Robinhood. It surged higher today on a piece of news that we're going to discuss in the heat map analysis, but somebody's betting for more gains to come here by buying these $17 calls for the expiration date this Friday, April 1st, with the expectations that the name could add another 7% to the gains by then. They paid around 43% apiece to enter this trade, all in all spending around $1 million. What about the ticker XME for the materials ETF? A winner for the year, but it's getting hit as of late as commodities dive down. Somebody's betting for more pain to come for the XME by buying the 56 puts for the expiration date May 20th, with the expectations that the name could drop down by more than 8% by then, and they paid around $2.50 apiece to enter this trade, all in all spending around $5 million. And here it is, the trade for the ticker NTR. Fertilizer stocks are down big in the last few days, and somebody's betting for more pain to come in the pullback of fertilizers, in this case NTR Nutrin. They bought the 90 puts for the expiration date May 20th, with the expectations that the name could drop down by more than 11% by then, and they paid around $2.20 apiece to enter this trade, all in all spending around $3 million. What about the ticker SHOP, Shopify? They're betting for more gains to come. In this case, they bought the 800 calls for the expiration date this upcoming Friday, April 1st, with the expectations that Shopify could add another 7.5% to the gains by then. They paid around $4.80 apiece to enter this trade, all in all spending around $4 million. What about the ticker PTEN? This is for Peterson Energy. They're buying calls, betting for more gains to come. In this case, the $17 calls for the expiration date May 20th, with expectations that the name could move higher by more than 11% by then. They paid around 85 cents apiece to enter this trade, all in all spending around $750,000. And lastly, the ticker IYR for the real estate ETF. A winner for the day, but somebody's fading the rip by buying the 103 puts for the expiration date May 20th, with the expectations that the name could drop down by more than 6.5% by then. They paid around $1 apiece to enter this trade, all in all spending around $1 million. All in all, when you see these bets specifically for calls for Shopify or Robinhood, the expiration date is in 3 days, so there is lack of conviction in these rallies. They're just gambling in call options right now and riding the wave higher. Moving on to the heat map analysis. The obvious is the winners year to date are the losers today. We're talking about energy, we're talking about Deere, we're talking about defense contractors, we're talking about names like ADM, the agricultural stocks, Nutrin, Mosaic, the fertilizers, all down big. And the winners are the losers year to date, the software names, chips, cyclicals, the automotives, and this has been the theme since the March 16 conference by Jerome Powell. Now, the notable winner today is Robinhood, and Robinhood is moving higher because it is now providing trading from 7 a.m. to 8 p.m. Eastern Time. So now you can spend more time losing money on Robinhood. Lots of fun, right? And here is a list of the winners that I track, just to illustrate for you. You see Berkshire down, you see some of the energy names down, you see Lockheed down, you see the agricultural stocks down big, ADM, Mosaic, Nutrin, John Deere. Now, did anything change here with the Russia-Ukraine peace talks? Did all of a sudden the sanctions been lifted against Russia? Did all of a sudden the wheat planting season just recovered in Ukraine? Are fertilizers moving from Russia to other ports all of a sudden now? Of course not. So the tailwinds remain intact for these names. But now you're getting a nice dip, a nice pullback to add them to your portfolio. Are you going to do that or not? Because it's easier said than done. People have been asking me, when should I buy Mosaic? I'm afraid to buy, and then the stock goes down. It went a little too high, too fast. Well, now Mosaic is down almost 10% in a couple of days. So here comes your dip Are you buying or not? Probably not, because this is 101 human behavior. And it might not be the right call to buy right away. It might pull down a little more. That's number one. Number two, we have distractions now. You might say, why shouldn't I buy Tesla or AMC or Apple even? The problem is the tailwinds for these names remain intact. For the fertilizers, for energy, for railroads, for materials, the tailwinds are intact. The headwinds, the technology high multiple names, also remain intact. What are the headwinds? The headwinds are the Fed and inflation. Take, for example, the news that we got for Northrop today, that the company could see as much as $59 billion in research and procurement spending over the next 6 years as the defense spending plan is revealed. We're talking about billions and billions and billions of dollars from this country alone, and now from other countries, Germany, Australia, Italy, UK. A lot of other countries are upping defense spending. All of that money is going to go in the coffers of these defense contractors. So am I supposed to abandon these names and move to Robinhood and Nikola? Excuse me, the hell is wrong with you? Moving on to the heat map for the ETFs. Again, everything is lining up green. The laggard is energy, XOP, XLE, but look at the OIH closing the green. Likewise, gold closing the green. It was obviously a growth kind of day. Growth outperformed value. The IWF, the VUG outperformed the VTV, IWD. Now, when we look at international markets, for example, everything is lighting up green, and the gains are led by European ETFs. This is what happens when we have peace optimism. Everything rallies higher, with exception of commodities, energy, materials. The winners year to date, the beneficiaries of the Russia-Ukraine war, tend to outperform. And of course, lastly, we have to talk about the VXX because it appears that Barclays screwed up big time, and it's going to cost them over $500 million. They screwed up the issuance of the VXX, and the value of the VXX is actually 24% higher than the assets that they have. So there is mispricing, and therefore you heard the news a few weeks ago when Barclays stopped issuing new shares of the VXX. And now we know why. They're holding a massive bag. It's going to cost them over $500 million. And that explains, by the way, why the VXX has been outperforming as of late, even though the VIX, the original VIX, has been trading down, because the supply was nowhere to be found in the VXX, and the demand was here, and hence the higher prices. Moving on to charts, and we start with SPY, the S&P 500 30 minutes chart. The melt-up continues, but we're getting really overextended at this point. When it's going to pull back, who knows? Do we have a sign of a pullback or a reversal of any kind here? The answer is no. The chart gapped higher. It struggled a little bit at around 459, but then it managed to make its way higher and close at the highs of the day, above 461. Is this bullish or bearish? The answer is it is bullish until we get a reversal signal, which we have none right now. When you look at the RSI, it is due. There's a difference when we say it is due for a pullback versus it's gonna pull back. When we say it's due, it's up to the chart to decide when. But we know we are in a time period where the chart should stop. And the higher it goes, impulsively so, the less likely that we will see a stalling and consolidation. And the more likely we will see a flush down, losing a few support levels in a short amount of time. And here's a daily chart for the continuous contract of the SPY, the S&P 500. Again, we're getting within that zone where the chart should start to pull back and reverse. Why? Because you look at the momentum indicators, they're getting toppy. You look at the volume, it is starting to move higher again. Yet the amount of flows, and that, by the way, solidify my thesis that we're seeing funds pumping the stock market before the close of the quarter. But the amount of flows is overwhelming to the point where the chart doesn't respect any resistance line. It just keeps going higher and higher and higher. The problem is, the higher it goes, the bigger the pullback. Because right now, you look at this chart, it's not going to stall and consolidate. Now, when this unfolds, we're looking for a sharp pullback, perhaps losing a few support lines. And it depends where the chart's going to stop for us to say whether the chart should be shorted or not. For example, if the pullback takes us all the way down to 4,472, then it's not a big deal. But if we have a sharp run down all the way to 4,384.5 and the chart closes below that line in, say, a couple of days, 3 days worth of pullbacks, then we got a problem. and we get a shorting signal. The chart did not respect any resistance lines, even 4,549.5. It continues to blast above, but we have to identify the new resistance here. And if we stretch that line, 4,657 is the number. Here it is. This is what I'm eyeing next. If the chart goes all the way there, let's see what the reaction would be. But in this chart, and all charts right now, time is more important because they're flooding the market with flows until when? The end of the month, which happens to be the end of the quarter. See, if this chart consolidated at around 4,472 for a few more days, perhaps a few more weeks, just moving its way within that range, I would have said there is a high possibility the SPY will go back to all-time highs at some point. But now that we have this impulsive rally higher, you cannot help but to say that this is another bear market rally. We will flush down big time once they're done with the pumping. And here it is, the SPX, the cash index, a daily chart. Yesterday, we've been eyeing 4,590. Well, one way you can beat that resistance is by cheating. And cheating means gapping higher in the morning. Then you don't have to worry about that line as resistance at all. And this is exactly what the chart did today. If we zoom in to a 5 minutes perspective, for example, as you can see, the gap higher happened, and then the chart went down and retested 4,590 to the penny before rebounding higher again. So we know that the chart knows this is an important line, and it did respect it by going back and retesting it as support. It's a cute way to cheat. The problem is, once you pull back and you lose 4,590, it's going to be really hard to climb above that number again. And here it is, a 30 minutes chart for the Qs, the Nasdaq. Similar story here. We got a gap in the morning, no crap yet. The chart struggled around 369 for a little while before moving its way higher and closing at the highs of the day. The support 369, the resistance 372. Any sign for a reversal here? Absolutely not. Is the chart getting way overextended? Yes, but that doesn't mean it's going to pull back tomorrow. You'll know when you know. You're going to see the pullback, and we're going to assess it and see whether it is a legitimate reversal or not. A legitimate reversal would be, for example, going down to close the gap and then failing to rebound and then closing below 363. That way, the chart lost a few support lines. It failed to close the gap. That is a classic reversal signal. And here is a daily chart for the continuous contract for the Nasdaq. Again, we were anticipating 15,000 to be tough resistance, but what do you know? The flows are so strong, the chart is not giving a damn about what these resistance levels are. It continues to move higher and higher and higher, but it is running out of time, and time is becoming more important than the price. So we have to identify the next resistance at around 15,260. But remember, the chart has 2 more days worth of flows before we say, okay, it ran out of time. So could it be 15,260 is the stop, or could the chart make it all the way to 15,500 before pulling back? Remember, the higher it goes, the bigger the pullback. The volume is stabilizing for now. The momentum indicators are plateauing for now. They already moved higher impulsively, and now they're starting to cool down, meaning we're getting closer and closer to the end of this move higher. What about the IWM, the Russell 2000 30 minutes chart? We talked about the importance of 204.5. That level of support was never lost, at least from a daily chart perspective. And today the chart gapped higher. It made it all the way above 208. Not only that, it managed to recapture 211 as support. Is it overextended? Yes, it is. But is this significant progress? Also, yes, it is. We're not going to have problems with this chart until 204.5 is lost as support. We could have a pullback. The chart could close the gap. It could go all the way down to 204.5. Then it rebounds higher again. So you're not going to short until that level is broken as support. DXY, the dollar index, the daily chart. A nice pullback today, and we still have negative divergences in both the RSI and MACD indicators. But we're not going to call the dollar dead until 97 is broken as support, because we've seen this movie before, where the dollar pulls back and then it continues to move higher the very next day. Did it get a lot weaker today? Yes, it did. But until 97 is broken as support, we're not going to call it. What about gold? Gold moved down a little bit today, but pretty much closed flat. The resiliency of gold is really stunning for now, given the fact that the dollar and the 10-year yield moved significantly higher in a short amount of time, which tells me that gold is not going to give up here. Gold is waiting and waiting and waiting for a new signal to initiate another rally higher. Because think about it, if gold wanted to go down, let's say, to 1,850, it could have done that a few days ago. Could have done that yesterday. It had ample chances to do so. Why didn't it? It is an interesting question, and I think I know the answer. The answer is because gold is not ready to move down. It wants to move higher. It's only going to move down if you whack it in the head with a hammer. And that hammer would be a massive surge in the 10-year yield, allowing risk on, meaning the economy is growing now. We have growth expectations moving higher. Then gold gets crushed. What about Brent oil? It went down all the way to the number 105.84. It actually went down by $1 or so at around 104.84, and then it rebounded higher. And it is critical for Brent right now to either move higher, and if it recaptures 118 as support, then we have another rally coming, perhaps to challenge the previous highs at around 140. But we're still not out of the woods yet. We have to see if crude oil is going to keep 105.84 as support or not. The buying signal for me would be recapturing 118. Then I'll have the green light to buy crude once again. And here it is, the chart of the 10-year yield, the daily chart, another pullback along with the dollar. Look at all of these signs, by the way. The rally in stocks started around March 16th. Along with a rally in the 10-year yield, by the way. Now the 10-year yield is pulling back, the market is not yet. That again solidifies my theory that the market should be pulling back, but it's not because of the insane flows right before the end of the quarter. For this chart, we're looking at 2.34 as support. The momentum indicators are highly extended. It is time for a pullback. The question is it going to be a revisit to 2.34 and then consolidation from that point on, or will it be a flush down? And a flush down, by the way, will intensify the inversion of the yield curve, assuming that the 2-year will continue to hold ground. What about the TLT weekly chart? We have a rebound. It's rebound day. Things are getting way oversold in the TLT, be it from a volume perspective or even a momentum indicators perspective. And therefore, I bought some TLT contracts today. I'm not expecting big gains, by the way. I'm not expecting the TLT to go back to 140. I'm just expecting a move all the way to retest 134.5 as resistance. That's all there is. The VIX 4-hour chart, look at this meltdown. A historic meltdown in the VIX, the likes that we have never seen since 2009, by the way. And now the VIX is getting way oversold. Why do I smell a trap here? Why do I smell that this is not right? That this is complacency? That this is not legit? Not a green signal for risk on, even though the VIX is below 20. Perhaps because we have other volatility gauges, for example, the Bank of America MOVE index, actually moving higher. Or take, for example, the JP Morgan Global FX Volatility Index, which is also moving higher. But somehow the VIX is going down. Does it make sense, does it? And now the VIX is trading at a discount. The realized volatility, the S&P 500. Most of the times, when this happens, we see a sharp snapback in the VIX, specifically when you put 2 and 2 together, and you realize that we have an earnings season coming up. This crash in the VIX is giving me the opportunity to load up in puts, specifically on stocks that I own, the insurance policy, because some of them are going down, by the way, specifically the commodities stocks like Nutrien, like Mosaic. So I'm taking advantage of cheap put options, cheap premiums, because the VIX is down to accumulate these puts ahead of earnings. But if this is right, we will see a snapback in the VIX, perhaps when the pumpers run out of time by the end of the month. We'll see. And here is the VXN, similar story here. 27.5 is the important line. The chart has been consolidating in a bear flag pattern. And this pattern has been playing out and the chart is moving down, but it is becoming severely oversold, and even as the Qs surges higher, we're seeing the losses tamed down in the VXN, which tells me, again, there is a trap coming. I'm just not sure when. And we will see the VXN snapping higher again, the Qs pulling back. And here it is, the chart of the day, the chart of the week, the most important chart in this market, Apple, a daily chart. Look at this, 11 days in a row, 11 green candles in a row. This hasn't been seen since 2003. So what happened here? Because this rally since 150 has added almost $500 billion to Apple's valuation. Is it really due to the iPhone subscription model? Of course not. This is flows. This is fund flows buying the largest stock because it is the most predominant stock in every ETF, and you're seeing the impact right here. The problem is what happens when the flows stop. That's number one. Number two, are the fundamentals in this company really improved by that much? Because sooner or later, we're going to face earnings season. In the last 3 months, for example, was the Chinese consumer strong or weak in consuming iPhones? They lost all sales in Russia, for example. Was the consumer here in the US buying iPhones or spending on gasoline and groceries because inflation is distracting their spending and moving it away from these unnecessities, be it goods or services, to what is necessity? Gas, groceries, rent. You gotta start thinking about that because you're not gonna wait till earnings season. You get a nice smack in the face, a negative surprise in earnings, and say, wow, I didn't see that coming. Well, the writing was in the wall. And the higher these charts go, the better the shorting opportunities. Here's another one. Tesla, the souffle, appears to be stalled for now. This is an hourly chart. It is stalling at around 1,090.5. When we read the chart, psychologically speaking, the pump started as a gamma squeeze, a stampede on buying call options. And then the retail crowd showed up and legitimately bought the stock. What happens now? Because it appears that we're getting into buyer's exhaustion. Meaning those who wanted to buy the stock already bought it. Those who want to buy the stock sitting on the sidelines saying, it's too expensive now, missed it. So what happens now? Well, if the buyers don't show up, then the sellers will, because you're going to have people who bought Tesla at 850, 900. And they say, oh, okay, the chart stalled here, now moving higher. I guess I'm taking profits for now. And the chart goes down, let's say closes the gap at around 995. Will the buyers on the sidelines be enticed by 995 as a price for Tesla? That is the case, then the chart rebounds higher again. But if that is not a good price, then the chart goes down 960, 950, and at some point, if it continues to move down dramatically and in a fast way, then even the holders who bought the stock, they start to bail out and they sell instead. We see a flush down in the stock. So it all depends right now on the psychology, because the technicals stalled. The chart is becoming overbought, technically speaking, and it's stalled at 1090.5. The psychology becomes supreme, specifically those who are waiting on the sidelines and those who are looking for a quick profits when they bought the stock and they're already in it. Moving on to BTC, tulips. We talked about BTC running out of gas a little too prematurely, but it wasn't an easy endeavor to break above 42,000 and the three amigos in, let's say, a week. So it is reasonable to expect BTC to run out of gas right now, perhaps a consolidation, looking for buyers. If the buyers show up again, we will see the chart moving higher. The problem is, unlike previous episodes of the mania, we're not seeing the abundancy of the retail crowd with a lot of money. A lot of them are holding bags right now. A lot of them are making quick gains, buying call options in AMC, GameStop, certain stocks here and there, but this one requires commitment. This one requires a lot of money, and we're not seeing that international flows like we've seen back, let's say, a year ago. But again, it's not a death sentence for BTC either. It is just stalling right now, waiting for new buyers to show up. Are you gonna show up? Am I gonna show up? Hell no, not me. You go first, and then I'll go after you. What about AMC, an hourly chart? A massive pop higher today, but we talked about the move getting way overextended. Today, I bought puts in the morning after the pop over 32. My assumption is the chart will go down to at least, let's say 26. We'll see some profit taking from the call options holders, and then we'll take it from there. Are we going to see a new batch of buyers with longer expiration date? If that is the case, then AMC will recover and move higher again. But if that's all there is, and everybody made their VIG, and it was a quick pump and dump, then the chart goes down, and I get to make more profits on the way down, since I missed the way higher by booking profits a little too early, shall we say. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? March 30th. We have the ADP report, which will be critically important. We also have a bunch of Fed zombies from Kansas, George Esther, and we have from Baltimore, Richmond, another Fed zombie, Barkin speaking. Anyhow, this is all I got for you for now, folks. Apologies for the voice. Didn't recover yet. I'm not using a new mic, by the way. My voice is still shitty. So I have to say goodbye. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.